Good morning. Today I will be discussing one technical indicator that is used in stock markets. It's called MACD. It is the full form of MACD is moving average convergence divergence. There are two views in the stock market. One view thinks that playing the stock market is gambling. The other view is that money can be made easily in the stock market. It's my feeling that neither of the two views are correct. And the indicator that I'm going to discuss today is one of the indicators trying to figure out whether stock prices can at least be predicted to some extent. Now, if we take historic price data series, it has fluctuations in it. If we want to smooth it out, then we need to take a moving average. Moving average convergence divergence is actually the difference between a 12-day exponential moving average and a 26-day exponential moving average. So while moving average smooths the original data, the difference between two moving averages actually is a spread. It further reduces the noise in the actual price data. As we proceed, we will see that this is not enough. We will also draw a 9-day exponential moving average of the difference. Okay, so what we are basically getting is this is the MACD line and this we call the trigger line. Let us now move to an actual demonstration with the help of stock price movement of a particular company. Now we will use meta-stock in order to demonstrate this particular technical indicator. We will look at the screen now. We will come to this meta-stock professional icon and open the screen. We go to this folder and the names of companies are there. We'll choose one company from the Nifty group of companies, say Axis Bank. Now time series data is given here. We can actually increase the time span as we require. If we take the cursor up to the technical indicator list and click on meta-stock and we open a separate window for meta-stock, then the MACD line is the red line and the dotted line is the trigger line. So the red line is the difference between a 12-day exponential moving average and a 26-day exponential moving average of the price line shown below, and the trigger line is the 9-day exponential moving average of the difference. Now how does this technical indicator work? Let us just zoom in a little bit. There are two aspects to this indicator. One aspect is, as we can see from here, there is a zero line. The MACD line, red line, moves up and down below the zero line because it's a spread. Always remember, a spread oscillates around the zero line. Now, when the red line is above the zero line, that is when the red line is above the zero line, we say that a stock is overbought. And when the red line is below the zero line, we say that this stock is oversold. That's one part. The other part is, since the dotted line is a moving average of the red line, the red line is faster than the dotted line. And we say that when the red line intersects the dotted line from below, it's a buy signal. And when the red line intersects the dotted line from above, it's a sell signal. I have my views on this. Point is, if the red line is intersecting the dotted line from below, it's a buy signal, but it's in an overbought zone. My recommendation is not to buy there. On the other hand, there is an intersection of the red line of the blue line from above, which is a sell signal, but it is an oversold zone. My recommendation is not to sell. So the way I would look at MACD, my recommendation would be that if and when the red line intersects the blue line from below in an oversold situation, buy. And when the red line intersects the blue line from above in an overbought situation, then sell. So MACD should be used carefully under such circumstances. We will switch to another stock now and try to see whether MACD, how to use the MACD line. We'll choose a stock like, say, Cipla, and we will again open the MACD line for this price movement in a separate window, and we can see that if we follow the MACD rule, for example, over here there was a buy signal. If one had bought, then prices actually did rise after the situation. And when in an overbought situation, when there was a sell signal, like here, if you see, if you had sold, then you would have not lost money, because after that prices did actually fall. If you look at the latest part, it has intersected from below. If you had bought, you would have made some money. So this is one of the many indicators that are used in order to understand future movement in stock prices and to take a position in a particular stock. Thank you.